Tony Dwyer of Canaccord is with us as well. Market insanity is an opportunity. That's a hard one to put in place when the Dow's down 700.
Yeah, it is. The popular definition of insanity is doing the same thing over and over again and expecting a different result. That's not insanity. That actually has hope in it, right? It's doing the same thing over and over again, knowing the exact result you're going to get and doing it anyway. Trying to predict what the market's going to do off of unpredictability with tweets and trade is insane. Like, you had a bounce back that was extraordinary on Friday, and now we had a tank that was extraordinary today. It just makes no sense to me. I think Karen really hit it with the Fed comment about transitory inflation. I think the Fed, that was almost like a reversal of the dovish pivot, where even though the 2-year and 5-year, the Fed has never been right once in predicting a recession. The 2- and 5-year Treasury yield is below the Fed funds range. It's screaming at the Fed that they need to cut rates, regardless of what Donald Trump is saying, President Trump is saying. It doesn't matter to me. I go with data, and the data in the Treasury market is telling you they need to cut rates, and that's been our call, as you know, since January. This correction, last time I was on the show, we talked about a 3 to 5% correction. I'm not going to be the guy that tells the people on air, I expect a 3 to 5% correction. You get 5%, and all of a sudden now it's 7 to 10, right? What is the difference between a 5% correction and a 15% correction is interest rates. Last December, we had 15 to 20% because the Fed was raising rates, and you were at 3% on the 10-year. Earlier in March, when we had a minor correction, and today, rates are going down, and the Fed is likely to have an even further dovish pivot.
I understand that you don't want to predict what's going to happen in the trade war, because that's obviously a losing game for anybody, even Karnak. But, when it comes to trying to game out the risks in the market, would you say that now, today, versus, last week, the risks seem higher versus a week ago?
For sure, but I think that's an excuse for the market. I'm sorry.
So that's an excuse for the market. You would say, therefore, the market volatility will continue throughout this period, or that there's more risk to the downside here? I mean,
no, I think if you look at the 10-week or 10-day rate of change on the VIX, similar to Timmy's RSI comment, you've already seen an extraordinary move. The 10-day rate of change on the VIX is up to, I think, 60, closed over 60 today. When you get that high, it doesn't spike again. And if it does, it's very, very temporary. So I think a lot of the fear is kind of in the tape on this move because of the direction of interest rates. But let me also throw this one by you. Offsetting to some degree, I wish I had the intelligence to know what the trade situation was. I don't have the intelligence or the resources.
Not sure intelligence is what gets you there.
Well, I'll tell you what I do know. A lot of people are refinancing their debt because you got the 100 basis point drop in interest rates. I know a lot of millennials that are able to now buy that starter house, and mortgage activity is picking up pretty big because rates have come down. There is an offset to the trade war.
And that's a good thing, but there's also probably concern, particularly among some small caps, that even though rates are low, that they've got a lot of debt, and there is concern that a slowing economy will impair their ability to pay the leverage that they already have, even if it's at lower rates.
Oh, for sure.
So it's a push-pull situation.
But that's the point. There's mixed all the time. Like, think of the governor on an engine. The governor on an engine, in case you're not aware of it, it gives it extra power or less power. Dan from Camillus, up from where I'm from in real upstate New York.
Fayetteville, brother.
Okay, I was close, Marcellus. Anyway, the bottom line is, when you can turn down an engine by changing the amount of fuel that's going into it. It's a governor of an engine. The amount of debt is not good. You cannot fix debt with exponentially more debt. It's the governor of the engine. If you go up to 3%, it slows the engine down.
Sure.
If you go down to 2%, it picks the engine up. We're in this kind of weirdo twilight zone of economic activity because the amount of debt. And every time we get to 2.5%, it's going to tank. And every time we get to 3%, it's going to rip. You look for a correction when everybody's on the wrong side of the boat. They were April 30th.
Okay.
Now everybody's getting on the right side of the boat.
Tony, thank you. Tony
Thank
Dwyer,
you, Mel.
Canaccord Genuity. What do you think of Tony's?
You drove an IROC Z too, right?
No, I didn't. With the louvers in the back, I didn't have that, but I knew people that did,
Right.
Tim.
But
with that, Tony, if you've listened to Tony, he's been spot on, and I'm not going to disagree with him here. But I will say this: we talked about the unintended consequences of these tariffs, or cost of goods in this country at some point will go up, which means inflation, almost by definition, should go up. And if the Fed's mandate is inflation, something they've been saying for a long time, they're going to find themselves, you think they're in a bad position now? Think about 3 months from now if this thing continues to drone on and price of goods goes up and inflation starts to tick higher. Then what are they going to do? So they've painted themselves into an extraordinarily difficult corner, in my opinion. So I think the pain trade is still lower.